Supply and demand is an important concept, and it's something that's very prevalent in our day-to-day lives. Supply and demand governs how we buy things, how we sell things, and really just how our economies at scale operate. Whether we relate this to buying groceries, buying video games, buying clothes, or even buying currencies, supply and demand is at the forefront of the decisions that are being made. So in short, supply and demand in economics is the relationship between the quantity of a commodity that producers wish to sell at a various price and the quantity that consumers wish to buy. It's the main model of price determination in economic theory, and again, it's very prevalent in our lives. The price of commodities are determined by the interaction of supply and demand within any market. Supply and demand are governed by two important components, price and quantity. And very simply put, as price increases, the demand for a particular commodity tends to decrease. And on the flip side, the supply for that commodity increases. And there's two reasons why it would increase. One being price is high. So when price is high, when you sell, you make more money. So you'll want to sell. And on the other end, since demand is low, supply just ends up being higher because there aren't any active or willing buyers to buy that supply. Now, on the flip side, if price begins to decrease, the demand for that product increases. And because the demand for that product increases, generally speaking, the supply for that product will be much more reduced, which tends to drive the price. When we see supply meeting demand, that's called fair value of price. And generally speaking, that is the acceptable value where a buyer and a seller match on what a good or service or commodity is worth. So for example, if someone is selling a TV for $100 and they found a buyer that's willing to buy that TV for $100, the seller values that $100 more than it values the TV in which it's selling. And the person willing to buy the TV for $100 values the TV more than the $100 that they're willing to give for that TV. That's fair value in price for both parties. And as a result, the TV is sold and both parties walk away happy. Now, if we just think about that in a different light, if the price was moved up to, say, $150, that buyer may not be willing to actually purchase that TV, which means there's a reduction in the overall demand for that TV at that price point. And we see that when we are grocery shopping, for instance, and certain things go on sale. People go crazy when certain things are on sale. They stockpile and generally speaking, buy up everything because the price is cheap. But when you factor in when price is so cheap, generally speaking, the supply is low. And what that ends up doing is it gets sold out very quickly. And we've seen that in grocery stores where something goes on sale and then these shelves are completely empty. We can also convey this with the recent trend in cryptocurrency mining and the relationship it has with graphics cards, computer graphics cards. Because crypto mining is such a hot item and a lot of people want to get involved in it, and they know it requires a high-end performance graphics card like the 3000 series NVIDIA cards, what we see in the marketplace is that the demand for those cards is incredibly high, but the supply of those graphics cards is minimal. So when you do actually find a card to buy, they end up being more expensive. You can also look at this for PS5s when they first came out. The supply was relatively low, but the demand was massive. So people that could get their hands on PS5s, a lot of them being scalpers, ended up selling them for atrocious prices because there was such a high demand. People were willing to pay well above the fair market value for that. The concept of supply and demand really does affect how we make decisions, and it's no different than a financial asset like a currency. Banks, institutions, and large hedge funds are operating under this entire framework of supply and demand. They're trying to buy currencies when they're cheap and sell them when they're expensive. They also know that if they're running a business and their inventory is actually holding currency and selling them for transactions, they will buy certain currencies when they are cheap, holding them for months, maybe even years, until that currency appreciates in value so that they can then turn and sell it. And banks do this all the time. Accounting departments do this to hedge their risk as well, but that gets into a little bit more of advanced supply and demand, because when you think about supply and demand, everybody has a reason for wanting to buy or sell something, and it's going to affect the price and the quantity that's both demanded and supplied, and the interaction between supply and demand. But now you're probably wondering, how does this really factor into currency? Yes, I understand that institutions want to buy and they want to sell, and yes, that's going to drive price. But really, how does that translate to a price chart? And how can I actually take advantage of it? So what we're trying to do when looking at supply and demand trading is we're trying to identify when an institution or large pool of money is entering the markets. We're trying to identify their footprints and trade alongside them. Now, of course, like I said, they're trading for a completely different reason. We're simply trading based on the footprints that they're leaving in the markets. So it's our job to identify when high points of demand from these institutions is created or high points of supply is created. Basically looking for when they're buying and when they're selling. And we can see that on the charts. Institutions are just simply unable to hide their position sizing because their orders are so vast. They move the market. And more often than not, when they do enter the market, they're not able to enter all of their positions in one go, which is why you'll see price gravitate back to these particular supply and demand zones and then continue based on those because they need to fill their orders. They might get 50, 75% of their order on the first entry, or maybe even 25% depending on liquidity and other concepts we'll discuss. But price has to return back to that area so that they can load up on their full size position. So let's take a look at the actual ways of identifying supply and demand on a price chart. So here we have two specific ways of creating a supply and demand zone. We have range created supply and demand, and we have pivot created supply and demand. The first thing to really understand is what a range is on a price chart. So a range on a price chart is simply a sideways correction or consolidation where you see price moving basically to the right side of the chart. It's not really moving in any direction up or down. It's moving sideways. It's very easily visible on any price chart. You'll know when price is consolidating and moving sideways. One thing to note is ranges can be found on all time frames, and sometimes you need to look up a time frame in order to see that you actually truly are in a range if you're too zoomed in. Ranges indicate one of two things. One being high volume order flow where many orders are changing hands and likely large players are beginning to stack orders at a fair value in price, which basically means that demand and supply are changing hands quite rapidly, but eventually you do see a large move to the upside or the downside depending on which side of the market is being traded. But again, it comes back to that concept of supply and demand. When there's fair value, orders are changing hands at a rapid pace and you're not seeing much movement on a price chart. When there is an imbalance in supply and demand, that's when you see price move rapidly in one direction because it's trying to seek more orders or liquidity to balance that supply and demand. Now, the other end of the spectrum of a range is also low volume in the market. And it gets a little bit confusing. I'm sure after me saying that, you go, well, how am I really going to know if it's high volume or low volume if ranges are both created by the same thing? And you'll see that. You'll see high volume tends to be a range, especially if it's at fair value. And low volume, if you see right as the New York session is closing and moving into the Asian session, price tends to range or consolidate, and that's because there's low volume at those market times. Or same thing throughout the entire Asian session compared to, say, London or New York session, the volume is inherently lower, therefore price tends to range more. So the volume dictates what's actually going to happen, but it can be confusing when price is stuck within that range because you're sitting there wondering, is it low volume or is it high volume? What do I do next? And the biggest thing to remember is we're not trading the initial reaction or the initial move out of that range. We are looking to catch the retest of that range if it truly is a supply or demand zone. The easiest way to determine which environment or volume you're dealing with is waiting to see what happens after that range is created. Does price rapidly move away from the range? Or does it just slowly trickle outside of the range? If it's rapidly moving away from that range, it's suggesting high volume, which implies that lots of orders have changed hands and that there was likely institutional backing, and we can use that as a footprint to potentially plan a trade. Now, on the flip side, if slow movement, if it trickles out of that range, it's suggesting low volume and more than likely not much has really happened. There just was simply not really any orders happening at that particular price level. A movement away from a range should be significant to clearly showcase momentum being injected into that market. We're trying to identify when large orders are being placed into the market, so we should see a rapid expansion away, whether it's up or down. If price moves out of that range and then immediately retraces, that's a further context of low volume. It might initially look like you have the willingness or an expansion out of that range, but if you don't see a whole lot of follow through and it just quickly comes back, generally speaking, that's a smaller injection of volatility, but generally speaking, not enough commitment to derive a supply or demand zone being created at that particular price point. So here we have an example of a range. And we can see quite clearly that price is trapped between a high and a low, and we're moving sideways to the right. Price is kind of contained between this high and this low. Now, if we consider the concept of supply and demand, we have premium pricing or supply, and we have discount pricing or demand. And then we have the equilibrium, which is the fair value pricing where supply and demand are being met. And what you'll see within these ranges, especially if you drop down to lower timeframes, there are a lot of moves back into the equilibrium points as well as premium and discount. And basically what's happening between this range is a lot of orders are changing hands because there's a fair value at that point. Now, what we see when we are looking for a demand or supply zone that is created from a range, we're looking for that rapid expansion away out of that range, whether it's to the upside or the downside. So if we're looking at range created demand, what we see is a sideways range, and then we see a rapid expansion to the upside, and then a move back in to that overall demand zone. And what we would be interested in as traders looking at this footprint is the move back down into this demand zone, looking for our entry here. We don't trade the initial reaction out because we don't know which way it's going to move. We instead wait for price to return back to that demand zone to look for entries. The same can be said for range created supply. We see that sideways range. We see price expand out of that range to the downside, and then we see price return back into that range and then continue. And that's what we're looking for. Again, we don't trade the initial reaction out of the range. We're simply waiting for price to return to that supply zone to look for entries. Now, another way of identifying and mapping out supply and demand is looking at pivots created in the market. And generally speaking, what you'll see is a sharp move to the downside followed by a rapid expansion to the upside. That would create a pivot demand. And then you'd see, again, we're not anticipating catching the move to the upside, the initial move. We're waiting for price to return back into that demand zone to look for our entries. And we'll touch on all of that later. Just conceptually, this is how supply and demand zones are created. Now, if we flip over to the supply side on a pivot, we get a sharp move to the upside followed by a rapid expansion to the downside. Again, we're not trying to catch that expansion to the downside. What we are simply doing is marking out our supply zone and waiting for price to return back to that supply zone. What the range and the pivots are the footprints of institutions or the footprints of large orders being created in the markets. And we simply don't need to guess. We just wait for these footprints to develop, and then we wait for price to return to these areas. And we'll touch on entries, on how we can frame up high probability entries using lower time frames, things like that. But at this point in time, it's really just about understanding the different ways that supply and demand zones are created. Now we understand the differences between how zones are created, whether it be range, supply or demand, or pivot, supply or demand. The next question you're probably wondering is, how do we actually map out these zones? I understand the concept between range and pivot, but when it comes to actually drawing them, I need to see candles. I need to understand how to actually draw these zones so I can patiently wait for price to return to these areas so that I can actually take trades. So what we have in front of us are a couple different ways of mapping supply and demand zones using these ideas and concepts of zone creation. If we start right here, we can see that we have that range created supply and range created demand. And we're using the range zone creation, or marking the zone using the range that is created. So when we're looking at range created supply, for example, we have a sideways range in price. We can see that price is clearly moving sideways. And as a result, we're able to draw our supply zone using the highest high and lowest low that builds that range. In this example, it ends up being one candle that creates the entire range, but as we can see, price is more or less trapped within that range before it moves to the downside. And then what we do is patiently wait for price to return back to that supply zone to look for a sell entry. Now, generally speaking, when it comes to actually marking out your range, trying to focus on 4 to 6 candles at most is the best way to approach it. Anything more and your zones could get too large, too convoluted, and we want to eliminate as much ambiguity as we possibly can when we are creating our supply and demand zones. Generally speaking, if you have more than 8 candles, you can typically go up a time frame and refine from there. And what you'll see is on that higher time frame, you'll probably have that 4 to 6 candles, and on a lower time frame, you might be able to refine using some of these pivot concepts, which we'll touch in just a moment. So again, if we're looking at range created supply and we're mapping out our zone, we would mark out the highest high of that range in price and the lowest low of that range in price, and then wait for that expansion out of that range that would break the range in price that was created. And then we would mark out our zone, and we would patiently wait for price to return back to that zone to look for entry. And the same can be said for range created demand. We'd be looking for the highest high and the lowest low of that range in price. We'd be waiting for price to expand to the upside, breaking out of that range, and then we'd be patiently waiting for price to return back to that range to look for an overall trade idea. Now we can take that a step further and refine our supply and demand zones that are created by ranges by using a concept of pivot. And basically, we'll start with pivots first. So again, what is a pivot? A pivot for a supply zone creation would be a sharp move to the upside before a rapid expansion to the downside, or a sharp move to the downside before a rapid expansion to the upside. If we're going to be marking out our pivot supply zone, we would be using the pivot candle that created that sharp move to the upside and then followed that expansion to the downside. Or on the demand side of things, we would be marking out as the sharp move to the downside before that rapid move to the upside. And again, we would be marking it on the bullish candle before the bearish move, or the bearish candle before the bullish move. We can also take that a step further if there are multiple candles that create that overall pivot in price. And in this example, we have 2 bullish candles before the bearish expansion to the downside. So we would be able to mark out our zone using both of those bullish candles. And on the flip side for demand, we would use the 2 bearish candles to mark out our zone after we get a bullish expansion out of that pivot. So now that we understand the concept of pivots, we can then apply that to the range created supply and demand zones. And as we can see within this overall range that has been created, we have 2 bullish candles before the bearish move that expands to the downside, or 2 bearish candles before the bullish expansion that breaks out of that range. So we're able to refine our zone to using just the pivots if we wish. As well, if we go back to the first example, we could also use this last bullish candle before this bearish expansion to the downside, or this bearish candle before the bullish expansion out of this area. And this just explains and further adds to the level of refinement that you can have on range supply and demand, and how we can also just use the concept of pivot to build onto the idea of range supply and demand. Because we know with ranges, price is at a level of fair value and a lot of orders are changing hands. And what we know with pivots is the pivot is created by that last candle that creates that up move before the rapid expansion to the downside, or that candle that creates that sharp down move before the rapid expansion to the upside. So we're able to mark our zones using that candle as well. And what this showcases is the level of refinement that can be seen on a price chart. Because if we were to look on a lower time frame at this pivot, generally speaking, what we're more than likely going to see is some sort of range that creates that. But even if we just look at it conceptually, we see that we have that pivot in price. We have that pivot in price, and that's ultimately what's creating the zones. So when it comes to mapping out your supply and demand zones, you have a little bit of flexibility in terms of what you are looking for, and we'll build on that as we go through the rest of the concepts. But something to just keep in mind, that you have a little bit of refinement that you can use, or you can be a little bit more generalized when you see ranges. That is entirely up to you. It's entirely up to what you test and what makes the most sense to you throughout your testing and your understanding of supply and demand.